Okay, this video is how to assess finite-lived assets for impairment. And this is primarily going to be PP&E, property, plant, and equipment, that we are depreciating over their useful life into the income statement. And at each period end, we assess these assets for impairment. And there's a particular two-step rule that we have to use to assess finite-lived assets for impairment. And let me show you that rule. So here's just the exhibit from the textbook. This is the impairment analysis of, they're saying tangible assets, but this is finite-lived assets, okay? Step one, okay, let's start at step one. We're going to take the sum of undiscounted expected cash flows, okay? So let's just talk about this first term here, the sum of undiscounted expected cash flows. What we'll do is we'll look at the asset and we'll try to identify how much cash flow is that going to generate for our business in the future, okay? And we'll sum all of those cash flows up. And then we'll ask ourselves, is that cash flow that we're expecting less than the net book value of the asset? In other words, are we going to be able to recover the net book value of the asset, or are we going to get really small cash flows that aren't really doing their job in justifying this high book value of the asset, okay? So is the sum of the discounted expected cash flows less than book value? That's a bad thing, okay? So if yes, that's bad. And we'll proceed to step two. If no, it means we've got lots of future cash flows and they're enough to sort of justify the net book value of the asset, and we can go down this no line, and this is good, okay? That means we're in good shape and we don't need an asset impairment under that scenario, okay? So let's imagine that we're in the bad scenario. We added up our future cash flows and they're less than our book value. Well, now we need to take an impairment. So now the key is to calculate the size of the asset impairment, okay? So if we said yes, the asset is impaired, and the write down is you write the asset down to its fair value, okay? So not its undiscounted cash flows. This undiscounted cash flows, this is just a list of cash flows that we're receiving in the future. But cash flows way in the future isn't that valuable to us today. So we need to discount all of those cash flows from the future to today to come up with the fair value. And so the fair value is another word for the discounted cash flows. Okay? And so let's go through sort of an example. And the oil and gas industry provides a nice example for this type of thing because they actually provide an extra disclosure of their future cash flows. So only oil and gas companies provide this extra disclosure. So this is Apache Corp, and they are an oil and gas company. So they pump oil and gas out of the ground and then sell it. And the development that they do for these oil and gas wells gets capitalized as PP&E. So here's their property and equipment section of their balance sheet. And here they have oil and gas on the basis of successful efforts accounting. So there's two types of accounting in the oil and gas industry for PP&E. There's successful efforts and full cost. And you don't need to worry too much about those two different types. Successful efforts, you account for these properties the same way any other company accounts for their PP&E. They've got certain proved properties that they've capitalized and unproved properties. They've got gathering, transmission, and processing facilities, and they've got other property and equipment for a total gross balance of 46.7. This is in millions. So that's $46.7 billion gross PP&E. Then they've got accumulated depreciation, depletion, and amortization. You can just think of that as accumulated depreciation of $28.3 billion. And they've got a net book value. So I'll just write NBV here. This is the net book value of their property and equipment as of December 31st, 2018. Now this extra disclosure, it doesn't exactly map onto this financial statement, but it's good enough for our purposes. So what they're doing here is they're projecting their future cash flows that they're going to get from their oil and gas wells. So these are the future cash flows that are going to result from the property and equipment that we're talking about. They're expecting future cash inflows here of $48.9 billion minus production costs of $18 billion, development costs of $5.6 billion, income tax of $3.8 billion, for net cash inflows. So this is the number we care about. The cash inflows from owning these assets is $21.4 billion. And this is undiscounted. So undiscounted future cash inflows is $21.4 billion. And that is step one. So let me go back to step one. We take the sum of undiscounted expected cash flows. Is it less than the book value of the asset? And so the first question here is, should Apache have recorded a write-down in 2018? Well, step one is to compare this net book value of $18.4 billion to the undiscounted cash flows of $21.4 billion. And you can see that those undiscounted cash flows are enough, they're big enough to justify the net book value of $8.4 billion. And so since $21.4 billion is greater than $18.4 billion, the answer is no, they do not need to record a write-down because they passed step one, okay? They passed step one, and so they proceeded down the, let me show you, they proceeded down the good side, right? The no arrow, and no asset impairment is necessary. Well, now let's imagine that what if we change this net cash flows number, right? What if instead we change that number to 18? Okay, what if that was $18 billion? Well, now step one has failed, right? Because 18 billion is less than 18.4 billion. So now we need to proceed to step two and calculate the impairment, okay? And here I've revealed what the impairment is. And what the impairment is you apply a discount rate to all of those future cash flows to discount it to today, okay? So this is discounted. UNTED, you discount those cash flows to today. Now this is all assuming that 10% is an appropriate discount rate, okay? This disclosure is called the PV10 disclosure. What is the present value of your oil and gas property and equipment using a 10% discount rate? So the company might determine that a different discount rate is actually appropriate. But we're going to assume 10% is an appropriate discount rate. And so the fair value, so this, when I say discounted, I mean this is the fair value. The fair value of these assets is $13.7 billion, and that's the number we need to write our book value down to, okay? So since we failed step one, step two is to calculate the impairment, and we write down the book value to its fair value. And so the amount of the impairment is $4.7 billion. That's just going to be a debit. We're just going to take additional depreciation expense this year of $4.7 billion, and we'll credit accumulated depreciation. We're just accelerating some of that depreciation expense. And just as a final note, what I want you to notice here is that this two-step impairment rule kind of buffers the company against recording an impairment. As you can see in the case of Apache, their discounted future net cash flows, their fair value is $13.7 billion. Well, that in actuality, so at December 31st, 2018, the fair value of these assets was less than their book value. So when investors look at that book value is actually not supported by the fair value of the asset. But since accounting rules require companies to depreciate these assets, we also allow for a bit of a buffer before you have to record an asset impairment. So step one is you get to take this higher number, $21.4 billion, to compare that to your book value. And if you pass that test, you can not record an impairment even if the fair value is lower than your book value. So 13.7 lower than 18.4. So that 18.4 is actually not supported by fair value, but we can still avoid recording an impairment because of this two-step impairment rule. Okay, so that is how to implement the two-step impairment rule for Apache. And not all companies, by the way, will give you this extra disclosure of future cash inflows. This is just oil and gas companies.